So welcome to the webinar. As you'll know from signing up, this is about the fundamental review of the trading book. This is a global change to the way firms are to calculate capital for their trading book and banking book. And what David's going to do is take us through some of the background to the change about the new approach to measurements and calculations, the standard approach and the internal model approach. He's then going to explain how by choosing how to represent your trading desks and how you structure the way you do your sensitivity calculations, you can make capital savings which are completely within the rules and obviously save you money. So, David has a long experience of working in risk management with a variety of global banks, Royal Bank of Canada, Toronto Dominion, CRBC, Scotia National Bank, and now with TMX. So he's going to take you through the slides and the maths. We've added some structure so you can see how this presentation fits together. If you've got any questions, then do get in touch. I'll now hand over to David, and he will take you through the slides.
Okay, so thanks, Bill. Hi, everyone. Welcome to the presentation. After years of struggle, FRTB was finally finalized in January this year. Now the implementation race begins. And that's the topic of this presentation, FRTB towards implementation. This is today's agenda. First, I will walk through FRTB, what is the major changes and its component, including standardized approach and the internal method approach. Then I will show a use case using the results from SA and IMA prototype to demonstrate that capital optimization can be achieved by moving trades. Thirdly, I will do the talk about industry challenge, and the Q&A will be followed. This slide shows the major change from FRTB. The first one is a clear boundary between trading book and banking book. So current boundary criteria is pretty subjective. So it's a bank's intention to hold or trade. But intention can change from time to time. New criteria is much more clear and objective. It's evidence-based. And second one is the revised standardized approach. It's using standard-based approach instead of a notional or cash flow-based method, which is a significant change because now it's not the pure standardized approach, but it's a mixed method because it needs to use the pricing model's sensitivity as inputs. And moreover, now standard approach is a must for all the banks, since SA number is to be used as fallback for IMA if IMA fails. So that means bank must calculate the standard approach even if it is allowed to use the internal methodology. The third one is the changed risk measure. So expect shortfall will replace VAR, and expect shortfall need to go to calibration for a stress period. Please note it, VAR still need to be calculated for the backtesting purpose. The fourth change is market liquidity risk. Current liquidity horizon is set to 10 days for everything, but now FRTB will set the liquidity horizon varies at the risk factor level, and the liquidity horizon need to be incorporated into expect shortfall calculation. The fifth change is revised internal model method, which includes IMA approval at the desk level, stress ES at the 97.5 percentile. Default risk charge DRC model will replace IRC, and the non-modulable risk factor will be added. And please note, securitization position must under standard approach. It cannot use internal method approach. Okay, this is the major change. And this slide shows the comparison between Basel 2.5 vs FRTB. As we can see, both of them has standard approach and internal model approach. However, under Basel 2.5, it's one or another. That means if bank is approved for IMA, it does not need to use SA. But under FRTB, SA is a must. So under the component of SA, Basel 2.5 is use standard charge, which is kind of notional based times the risk weight for different category. And in FRTB, this is split into 3 components: sensitivity-based approach plus standardized default risk charge and add-on charge for the residual risk. So this is a standard approach. And for internal method approach, marketable risk factor is calculated by VAR plus stress VAR for Basel 2.5, and it will be replaced by expect shortfall calculation. IRC, which is incremental risk charge, will be replaced by IMA DRC, which is a default. And the CRM, which is incremental risk charge, CRM, which is comprehensive risk measure, will totally gone because under FRTB, securitization position must use SA. And the risk not involved will be replaced by non-model risk factor, and the idiosyncratic risk, including DSR and ESR, will also go here. So this is the component. And here we list some of terms we used the last page. So just for your reference. So this is the internal model approval process. Since we have SA and IMA, this is the process to determine which one to use. So first, we were starting with the overall assessment of bank's firm-wide internal risk capital model. If it is failed, then entire trading book will need to use standardized approach. If it is passed, bank will nominate the desk for approval. For the ones out of scope, we need to use a standard approach for them. For the ones got nominated, it needs to assess the model performance, including P&L attribution and backtesting. For the ones who fail the assessment, you also need to use a standardized approach. And for the one passed, we need to assess the risk factor, whether it's multiple or not, based on the criteria is the real price and the frequency trading. So for the ones multiple, we're going to use expect shortfall. For the ones not multiple, we need to use non-multiple risk factor add-on. And also we need to calculate the default risk charge for the defaultable position. So once again, please note, securitization must use SA. It cannot IMA. So this is an approval process. And now let's talk about the structure of the standard approach. This graphic is directly quoted from FRTB document. So as we mentioned before, standard approach has 3 components: sensitivity-based method, default risk charge, and the risk add-on. And the sensitivity-based method has 21 components, which is divided into 2 dimensions. The first dimension is the 3 sensitivity type: the delta risk, vega risk, and the curvature risk. And the other dimension is a 7 risk class, which is a general interest rate risk, credit spread risk, foreign exchange risk, equity risk, and commodity risk. Credit spread risk is further split into 3 components: for non-securitization, securitization, non-correlation trading portfolio, and the securitization correlation trading portfolio. So altogether, they have 7 classes. So total charge is the sum of 21 components in SBA with no diversification effects, and plus the default charge and the add-on. It could be simple sum of the 23 components. So for the default risk charge, it's built for 3 defaultable risk class with prescribed parameter calibrate to banking book-based treatment of default risk with some adjustment. And the residual risk is add-on risk to capture the gap. It is risk-weighted notional based. So now let's talk about the sensitivity-based approach. As we mentioned, it is significant change for standard approach. SBA is added at the final stage for FRTB. Originally until CP2, FRTB standard approach was cash flow based. So this is the SBA capital calculation. It is a 2-stage process. Top down first, then bottom up. Top down to map a position sensitivity into risk factor, and the bottom up to aggregate the risk charge. And this slide shows the top-down process for mapping. So the step 1 is identify the underlying risk factor, risk class for each instrument, as well as the associated risk factors grouped by by buckets. So under risk class, buckets are predefined and they may have a subgroup under them. Step 2 is calculate the sensitivity and net at the risk factor level. So please note it, one instrument or trade can have multiple risk factor class belongs to multiple risk factors. So for example, a simple stock may have equity delta as well as FX delta if this currency is different from reporting currency. So you will see the example in the use case below. So this is a mapping process. So basically you map down to risk factor level and got its net sensitivity. Then this is the second part, aggregation for risk charge. So sensitivity-based approach is basically a variance-covariance approach. It needs correlation and the risk weight to aggregate sensitivity to one number for risk charge. So let's start the process in the graph. So after the previous steps, it gets the net sensitivity at the risk factor level. Then times its weight, we'll get the weighted sensitivity. And we used intra-bucket correlation to aggregate the number to reach the bucket level risk charge. So after that, we will use inter-bucket correlation to get the component risk charge. So once again, for a summary, we need the risk weight, correlation inter-bucket, and the correlation cross-bucket to aggregate the sensitivity to one number risk charge for the risk class components. Then SBA capital is the sum up of 21 components risk charge. So this is the aggregation process. And these slides talk about the curvature risk. So previous steps are to capture linear risk, and the curvature risk is to catch up the non-linear ones. So compared to delta, linear risk, curvature risk have much larger shock. For example, GRR might go to 240 bips. So as we show in this graph, first we will take both positive and a negative large shock, get a scenario loss taken out of delta effect, And then the worst of two scenarios will be flip the sign and take as curvature risk. Therefore, the positive gamma will lead to negative curvature, which is usually ignored in the risk charge calculation, because positive gamma is the good gamma, which is always increased portfolio value, no matter underlying goes up or down. And you will see that the effect in the use case later. Aggregation for curvature process is quite similar to delta aggregation, except it ignores negative curvature in the general case. So as we show in the graph, first step is to calculate curvature. Then we aggregate use inter-bucket correlation. And then again, we aggregate use intra-bucket correlation to reach the component charge. So last step of sensitivity-based approach is the scenario correlation multiplier. So after risk charge is calculated, three scenarios are created to reflect correlation change for the stress period, which is a high scenario with a multiplier 1.25, medium is 1, and low multiplier equals to 0.75. Three capital charge are performed based on the scenario multiplier times inter-bucket and intra-bucket correlation. And for each correlation scenario, we calculate portfolio level risk charge, and the ultimate portfolio risk charge is the largest of three correlation-based capital charge. So basically, correlation will be shocked for three scenarios, and the largest one will be used as the capital charge. So this is the SBA. And now let's talk about the internal model approach. The major revision to the IMA framework is moving from 99 percentile VAR to 97 percentile expect shortfall to better catch the tail risk. And the expect shortfall need to be calibrated to 12-month period of stress to better capitalize the loss from the stress period. And the stress capital for non-multiple risk factor. And also different liquidity horizon defined at the risk factor category. So please note the VAR still need to calculate again for backtesting purpose. Although VAR is not in a capital process, it need to be used for the backtesting. So this is the expected shortfall. Expected shortfall is the average of the tail scenario. So it is to capture the tail risk ignored by VAR. So alternative for alternative term for expected shortfall is conditional VAR, average VAR, expected tail loss. So basically they all mean the same thing. So it is not a new concept for the expected shortfall. And the current VAR is based on 10-day 99 percentile VAR. And as we show in the graph, one PNL is normal distributed. Expected shortfall 97.5 percentile is at a close value of 99 percentile VAR. After the base expected shortfall, it needs to incorporate liquidity horizon into expected shortfall. So first, let me explain what is liquidity horizon. It is the time period required to liquidate holding positions. So in the left-hand side, we have 5 liquidity horizon category: 10-day, 20-day, 40-day, 60-day, and 120 days. On the right-hand side, risk factor category is mapping into liquidity horizon by 2 dimensions. First dimension is 5 risk class, which is interest rate over here, credit spread, equity over here, and FX and commodity. So it's 5 risk class, 2 less than standard approach, because securitization, which is correlation trading portfolio and non-correlation trading portfolio, they can only use SA. So these two does not exist in internal method approach. So we only have 5 in IMA, while standard approach has 7. So the other dimension is by risk factor type, which is the spot and the volatility and the other types. Incorporate the liquidity horizon is done by this formula. So ES calculation is done at a base liquidity horizon of 10 days, which is T over here, and then scale up using the square of time law. For the formula, T is always set to 10 days for now. So only 10-day expect shortfall is needed for building block, even for the risk factor at 120 days. So after base 10-day ES, it needs to calculate the partial ES, which is ESPJ over here, for the rest of liquidity horizon in rational style. So for example, when calculate liquidity horizon for 20 days, it needs to include all risk factor except risk factor for the 10 days. So we have 3 10 days over here. If calculate the 20 days, you just exclude these 10 days. And the partial ES here means only the risk factor involved are shocked, while other risk factors are kept constant. So we have 2 types of partial expect shortfall in the FRTB. And the liquidity horizon is 1 type. And the other type is by risk factor. It's IR, FX, EQ, commodity, and the credit spread. We will mention it later in the capitalization of risk factor. So this is the liquidity horizon incorporation. And the next slide is for the stress ES. So after liquidity horizon, ES need to be calibrated for the stress period. So the first step is to identify stress period. Stress period is 12 months period that the portfolio has the most significant loss for the history, which must go back to at least 2007. So we red highlighted over here. So after the stress period, we need to identify the reduced set of risk factor. Because not all risk factor exist in the stress period. However, reduced risk factor is at least 70% of the full risk factor. So for example, if we have 4 risk factor for now, it needs at least have 3 risk factor in the stress period to use for IMA. So after that, it needs to calculate ES stress for the reduced period as the base ES. And then we scale up by the ratio of stress for the full risk factor for the current period divided by ES for the reduced factor at the current period. And this ratio is floor at 1. So as we can see, we have 3 ES involved here: ES stress reduced, ES current full, and ES current reduced. So this is the stress ES. So after that, we need to capitalize of risk factors. So please note it, although the model approval is on desk level, but the capitalization is on risk class level. So similar to standardized approach, it map each instrument into individual risk class FX, IR, CR, EQ, and commodity. And then calculate partial ES, or it's called constraint ES, for each of risk factor class, as well as the ES for the full risk set, which is unconstrained ES. So the aggregation of the capital charge for multiple risk factor, which is called IMCC over here, is a weighted average between ES4 and the simple sum of partial ES for our risk factor. And the low, which is the risk weighted over here, is set to 0.5 for now. So the above is the 4 steps of IM calculation. So let's go back. So first we calculate expect shortfall. Then we incorporate liquidity horizon, which involve 5 liquidity horizons, so 5 years over here. And then we do stress calibration, which have a 3 calculation over here. Then we do the capitalization, which have a 6 years calculation. So years for all the risk factor, each risk factor and all of them. So it has 6. So roughly speaking, it has 90 times of ES. But to be specifically, it has 63 times because not all risk factor has all 5 liquidity horizon. So I can see computation power is great needed over here, as long as consider VAR still need to be calculated. Okay, so this slide shows the final capital charge. So after above steps, we got the capital charge for IMA desk and SA desk. So for IMA desk, we need one more thing, which is capital multiplier. It's MC over here. And the capital multiplier is coming from bank level backtesting. FRTB's backtesting is done by 2 levels. Desk level is to determine whether this desk is eligible for IMA. And while bank level backtesting is to determine the total IMA desk multiplier, which ranging from 1.5 to 2, depends on the number of outliers. And that is a similar mechanism as current VAS backtesting. So after that, the total capital, ACC, is the capital for approval desk plus capital for unapproved desk, which coming from SA, and plus standard risk charge. So this slide is the final capital charge. Okay, so let's quickly summarize the desk approval assessment. We mentioned some of them before, but let's summarize here. So first point is model approval will be done at desk level. And the assessment of model performance will be including evidence from backtesting and the P&L attribution. And standard approach also need to be calculated and used as a fallback number for IMA desk, just in case it fails. And this is the P&L attribution. It's pretty new concept in FRTB. The purpose of P&L attribution is to compare front office P&L with the middle office P&L to make sure the consistency between front office pricing and the risk pricing. The difference of them is unexplained P&L. 2 passing criteria is proposed for the P&L attribution, which is the mean of unexplained P&L divided by standard deviation of front office P&L need to be less than 10%, and the variance of unexplained P&L divided by variance of front office P&L need to be less than 20%. Desk cannot have more than 3 breach of this condition, over the past 12 months for the IMA implementation. Otherwise, desk need to be used SA. So from this criteria, we can see that it is easy to pass for directional unhedged portfolio or outlier position. But it's uneasy to pass for the hedged position because very small deviation in P&L between the outright and hedged position can lead the ratio to fail. And that is one of the reasons that banks need to do desk restructure. Okay, this is P&L attribution. So the above is the walkthrough of FRTB. Now let's talk about our use case. So this is the steps of use case. First, I will book some hypothetical position, including equity, interest rate, and FX exposure. And secondly, I will show their risk profile from standard approach and the internal model approach perspective. Then I will load them into hypothetical desk structure and show the capital charge. Afterwards, I will do the capital optimization by moving trades from high charge desk to low charge desk using what if. So this is the general steps. And this is the hypothetical position and their market to market, totally 11 position. They have 3 equity position, which include the NGD stock, which is Canadian stock, and the IBM use equity, and the IBM call option. And also for IR desk, we have 7 IR position, including 3 bond and 3 swaps and 1 swaption. Last one is the FX position, which is FX barrier, and our assumption is this position always stay in a standardized desk. And most of them are long position, but only 3 of them are short, including IBM stock, swaption, and FX barrier option. Moreover, all of them are USD position except the first one, NGD.TO equity. It is in CAD. So since our reporting currency is Canadian dollar, so most of our position will have FX risk charge. So now I will show you the risk profile using the standard approach and the internal method approach. So this is the capital charge comparison between the standard approach and the IMA approach. As we can see, generally speaking, standard charge is much larger than IMA charge. The green one is the standard charge and the blue one is IMA charge. However, the special case may happen if the position is too volatile. So this one, NGD stock, is an example. NGD is a Canadian stock. So for SA, its risk weight is 50%. While in IMA, it has much larger change because it has large stock jump from $3 to $1.2 in 2008 for stress period. Therefore, it has much larger than 50% risk weight. Consider IMA has a multiplier of 1.25. And this is the SA risk profile for those positions, decomposite by the risk factor component by equity delta, equity vega, and equity curvature, FX delta, FX vega, and FX curvature, and GIR delta vega curvature. And the SBA total charge is the simple sum of its component charge from risk class and the delta vega curvature. So the example over here is, so first is NGD.TO. It only has equity delta since it's a Canadian stock. Well, IBM stock has equity delta as well as FX delta since it's a US stock, while our reporting currency is Canadian dollar. And this one is interesting. So IBM call option, supposedly they have 4 components: equity delta, vega, and curvature, plus FX delta. However, the graphic only shows 3 components because its curvature risk is 0. So as we explained before, since it's a long call option, it will have positive gamma, which lead to negative curvature, and this is ignored in curvature risk. So therefore, this position shows 0 curvature risk. Another example is a swaption. It's a short position, so it shows 4 components fully. So it's a GIR delta, vega, curvature, and FX delta. Now let's look at the IMA risk profile. So its component includes ESR and ES, constrained ES for IR, EQ, and FX. And the capital charge is equal to multiplier times 0.5 times ESR plus 0.5 times sum of all constrained ES. And here, our assumption is it passed backtesting and got multiplier of 1.5 for the calculation. And now we load the position into hypothetical debt structure. So on the left-hand side, we show the debt structure. Trading book is separate into IMA desk and SA desk. And furthermore, IMA desk has IR and EQ desk. IR desk will hold 3 bonds and 3 swaps. And the EQ desk will hold 2 equity and the equity European option. For SA desk, it has IR derivative holding swaption position. And the FX derivative desk will hold FX barrier option. So from right hand side is the capital charge from IMA and SA. So as we can see, all desks need to calculate standard approach charge, while IMA desk calculate IMA charge. Moreover, you can see that diversification effect exists in IMA desk since the total charge for IMA is less than the sum of its components. So we can see that have a diversification effect. Moreover, same thing happens for the SA desk. It also has some diversification effect over here. So this number is also less than sum of the above 2 components. And last point is the total charge is equals to the sum of IMA desk total charge plus SA desk total charge. So these 2 numbers adding up together to get total charge. Okay. Now let's do the capital optimization. Follow our intuition that trade should be moved from high risk charge desk to low charge desk to reduce capital. So this is our first try. We will move the swaption from SA to IMA since swaption has much higher charge SA than IMA, as we show in the profile. And here is the results. IMA capital increase, but SA capital decrease significantly. So the total capital charge is saved by 0.9 million. So first try did works. It did save some capital over here. And this is the detailed drill down number to showing the capital charge change is before and after. By moving the swaption trade, the capital did be reduced. Okay, so let's try to do another test following our instinct. If you remember, NGD has higher charge in IMA than in SA. So how about we're moving that trade into SA desk and see what's the impact capital change. And this is the results. After the transfer NGD to IMA desk to SA desk, IMA charge was reduced, but the SA charge increased a lot. And the total charge, instead of going down, it goes up 2%, and the capital save is negative over here. So this is achieve a negative capital save. And the reason is, although NGD position alone is charged higher capital under IMA, moving it to SA cannot reduce capital because IMA diversification effect. And you can see that effect in its detailed number drill down. So as we show in the graph, after the transfer, IMA equity desk is significantly reduced for capital charge. However, total IMA desk level, the reduce is small because of the diversification effect. While in the SA desk, since originally only have FX position, adding equity position has no diversification effect at all, and the total charge become add up in this case. So only in this case they don't have a diversification. So generally speaking, SA still recognize diversification effect. So therefore, total charge is not reduced, although the individual desk may reporting much less number. So in this case, moving trade from high charge desk to low charge desk does not reduce capital due to the diversification effect. Okay. Now let's take another try. We're gonna scale up the position size of NGD. Then we move and see what is gonna happen. So, and here's the results. This time, decreasing in IMA is much larger than the increase in SA. So the total capital is saved by 25%. And the reason is, this time position has much larger exposure, which can overwhelm diversification effect. And this is the breakdown of this moving. So by 3 try, we can see that capital optimization can be achieved by moving trades around, but it's not always follow our instinct. It needs to consider the other position in the trading book and thinking about diversify effect. And we need the what if tool to see the real impact to achieve the capital optimization. So next step, we're going to talk about the industry challenge. The first challenge is to build a standardized approach, because usually we don't have it before. And now standard approach is not alternative but it's not alternative. It has to for everybody. So there, sensitivity computation is an issue because SBA require a large volume of sensitivity calculation, and moreover, it requires effective risk aggregation function to calculate risk charge quickly. And the second challenge is the desk restructure due to two reasons: P&L attribution for model and data consistency, and desk level approval. As we mentioned before, P&L attribution is much easier to pass for the vanilla desk, but it is hard to pass for structured desk. So probably bank might need to separate vanilla desk from structured desk to help them to pass the P&L attribution. Another challenge is from non-multiple risk factor. It will require high quality and timely data to avoid punishment from non-multiple risk factor. So the other one is the computation power is strongly needed. As we demonstrated before, it needs so many times of ES simulation. We estimate at 63 times, and as well as the original VAR still need to be calculated. Therefore, it will require much more computation power than current required by the VAR capital system. And moreover, SA aggregation engine is also a challenge for computation power, as it needs to consider diversification effect instead of simple adding up. Okay, that's the end of presentation. So any question?